Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Monday, November 17th, 2025. It's 11:27 a.m. Eastern Time as I'm starting the video, so we're about 2 hours into the trading day. And what I'm going to do in this one is keep it limited to the equity markets. I actually started one earlier today, and then by the time I was getting into all the nitty gritty, I had planned to cover both trade ideas, give you updates on a lot of the different things that I've been watching and highlighting and trading recently, including the grains, natural gas, precious metals and miners, of course, the equity markets, different sectors. So again, that one would have gone, the rate I was trending over an hour. So I'll just break this one down to the equity markets, short and long term, and just continue to reiterate this week is likely to be choppy like last week. VIX is waking up. It's perked up lately. And you have NVIDIA reporting on Wednesday. NVIDIA is the big fat everything burger. By far, no one will argue the most important stock out there right now. Both mathematical weighting on the indexes plus the king of the AI bubble. And so we'll certainly see this market go, or most likely go one way or the other after they report. So this is the realm of the active trader. Last week, I don't usually post, nor do I trade always as active as I was last week, but in and out, in and out. We were able to thread the needle on the Nasdaq 100 futures, or QQQ if that's your poison. I also very closely watch SPY, the S&P 500. So let me just kind of recap. I'm going to probably be doing taking that down a notch this week. I'm certainly lighter on the last post I made last week. You can get there all in the comment sections. I'll try to get to those in a second. Went home short, reversed one last time before the close. Modified my next bounce target, closed it out early, and then went home short, and I've now covered and gone long here. And so this is SPY. Again, what I'm covering right now, I'm just starting with the short-term charts. This is not for everybody. In fact, this is probably not for the majority of people listening to my voice. Active trading, 5-minute charts, in and out, in minutes can change my trading plan on a dime, depending on what I see. But we're gonna have NVIDIA again report this week, so I don't expect huge fireworks. It's still hanging in there, and you can just game these levels. Like I said, traders absolutely love these gaps. I'm just highlighting the gaps right here for you. There's a lot of them in the recent weeks, especially. You can see, and you can just take those lines across, as well as price levels, reaction highs, reaction lows. So you can see here. So this is basically, we had a gap right here, took it out to backfill it, backfilled it perfectly right there. That was a backfill. This is how gap trading works. And then check the bottom of the gap again. Then once we cleared the gap, gapped up again, put another gap. You can see. So these are all the levels. Again, this is short-term stuff. This is SPY, the S&P 500. And, from a, or short-term perspective, the same divergences that I like to look for on daily and weekly charts for longer-term swing and trend trades, you can see those things work just as well on the 5-minute charts. You get a divergent low, you rally. Get a divergent high, you correct. You get a divergent low, you rally. And this is a pullback to support. So wouldn't surprise me today to see us go up here to this level, about 679.03. So like I said, I came in the day short, reversed it, and for now, and I may don't follow me. You won't, because if I reverse it, last week I was giving updates because somebody was asking, so you're getting frequent updates every time with charts. I'm not going to continue to do that, and I'm also going to be less and less inclined to start gaming these little, half 1% move. If you have enough futures contract, I don't have to tell you how many thousands of dollars in your pocket that puts. So again, everyone's going to trade their own amount, but when you're active trading, day trading, you just typically take larger sizes for those day trades to account for the below average gain and loss potential that you're going for there. So there's SPY. That's the 5-minute chart. There's the same support level on the 15-minute chart. And then my trading vehicles, QQQ and NQ, or NQ typically, but with QQQ charts very much relevant. And this is it right here. So on the 5-minute chart of QQQ, you can see I'm going to lower this line down a little because it'll account for that reaction where I just had it on SPY. And there's also a gap right there. And so that's, support testing last week's lows, Friday's lows. And this is just a potential downtrend line. This is resistance right here, next resistance. And then this is that level that if we can get some short covering before NVIDIA, still a max bounce target. But again, as I was very actively posting those intraday charts, and again, that's in the comments section. Like I said, I'm going to try to get away from that this week, or at least posting so much because, my confidence gets less and less high, and you start to see more erratic moves, false breakouts, whipsaws leading up to and then right after the NVIDIA support. So there's all those charts. And the last one being right here, change trading plan. Yeah, so looking, closed out the longs, looking for one last leg down. And there's the NQ targets, NQ chart too. Okay, may have been a little pause there. Unclick. Re-click the record button, the pause button, and hopefully I got all that. I don't know if there's a part that wasn't being recorded, but this is again the 5-minute chart of NQ, and this is my 15-minute chart of NQ, or hourly chart. And let's move on to the bigger picture. Okay, bigger picture would be QQQ. And go out to the daily chart. Support levels below. Remember, on probably the most important thing that's happening right now, you have a test of this uptrend line right here on QQQ that originates off the early May highs. I've got a total of 1, 2, 3, 4, and then recently 5, 6, several reactions there. And it comes in perfectly recently with the 50-day exponential moving average, which both man and machine alike will buy pullbacks to a bull trend once that 50 is taken out, like it was right here. Once it's clearly taken out, you're below it, and then you're in a bear trend, at least on that time frame. And then when you take out the 200s, those are longer-term key moving averages. So my expectation will be, and is, that we will take these out. NVIDIA is the most likely foreseeable catalyst, again, Wednesday after the close. And then that would take us down for another test of the 200-day moving averages, which ultimately will probably be lost. But again, man and machine alike will tend to buy pullbacks to the 200s. And if you overshoot them, sometimes you'll go down there. There was 3 days, there was some buying there. You bounced them on the initial pop. Then they lost them. And if you lose them, if you undercut them without stopping or with a very small reaction, you'll usually come and back test them from below. So for those that missed that opportunity to add to shorts under the 200s, you had a gift right there. And then this is where the 200s were recovered. And if you look at the daily chart, 589 is the first decent support that I have. That's that big important Friday low right there that I said after that whole week, and I've been maintaining that needs to get taken out to open the door to the next wave of selling. That'll take us down to 556, almost 557 right there as the next support. So we'll just call that T1 and T2 if you want targets on the daily time frame. I also worked up the targets on the weekly for you. I'll get to that in 1 second. So T1, T2. And again, guys, if it goes the other way, if the market loves what NVIDIA is selling, then we go up. If anything changes, I'll let you know. Anytime soon, any new high, if it happens, the market happens to make a marginal, and that's the operative word, marginal, meaning ever so slightly higher high, and then reverses, it'll still be a divergent high. So there's not going to be any change in the longer term, in the daily or weekly charts. It wouldn't be ideal or optimal for the bearish case because we already had the primary trend line breakdown. Remember, right there was sell signal 1, breakdown to that trend line, back tested, rejected. Then the secondary trend line was broken, back tested. But that's it. All I can do is give the levels and tell you how to react if they're taken out. So if T1 gets taken out, again, ideally, everything is ideally after NVIDIA is out of the way, then the market can focus on what it needs to. And that's 589, 556.87, so give or take. And if the 200s are taken out, then we're going to turn to longer term targets. Now to that real quick, this is QQQ. This is the my weekly chart. Back here, we had a bear market in from late 2021 into the about right around the beginning of 2023, because we about double bottom QQQ. That one kicked off with a bearish engulfing candlestick, short-term trendline break, and ended with this whole divergent low. And why does it say bullish engulfing? I know we had a bullish engulfing on daily. It was on the daily time frame is what it was. All right, and it gave us this. So then here I gave you a total of 7 price targets last year. T1, 2, and 3 were hit. When T3 was hit, that was when I stated, for all the reasons, there was a lot of coverage up there. We were short. We milked every penny of that going in, and then I told you in the comment section below that day, to be clear, and then followed on videos, closing all shorts, going hard long, rally back up with a bounce target back to the 200s with an objective reshort entry, but no more shorts above the 200. So we milked the long up. That short didn't pan out, and then we went above the 200s, which was a stop out point. No more shorts. Tried it one more time up here on the daily time frame with a stop above 580. I think it was on that bearish engulfing. Stopped out for negligible loss, and now this is the current trade. And again, these targets haven't changed. This is just a continuation of a trade that hit our early targets at T3, bounced, happened to make a marginal new high, kept the divergences intact. So now T3 was and still is T3. We never took it out, so it needs to be taken out. I believe will be, but until it is, that is what will open the door to these additional targets if and when taken out. So what I've done now is, even though these 3 targets were hit, now is the time to cover reverse. I've given you 2 new targets on the weekly time frame right here. So I've updated this chart for the first time in a while, and that's I have it about 539.20. If and when this uptrend line, that's the same one I just gave you on the daily, goes. Remember, we're already on a sell signal. Breakdown back test of the primary uptrend line. This is another trend line here. When that goes, that should take us down to T1, which will also come in with the 200-day / 40-week moving averages, give or take. That will be a drop of about 11% if hit. T2 is down here, just under 502. I have that at 501.91, but again, cover a little above the support level you're targeting. And that will be a drop from where we're at, not from the highs, from where we're at, about 17%. From the recent highs, which was a back test of the trend line, that would be about a 21% drop. And then we still have to take out T3 because we had a successful bounce reaction off that level. And then when that goes, again, that will be a total, if hit, big if, and I'm going to talk on that in this video. And then the next one will cover individual trade ideas. That's going to be a drop of about, a bear market of about 58% or so. Okay, so I'm going to show you a few charts for those of you either new to the site or been here and maybe for a little while wondering what I'm smoking. For those of you that have been here long enough, we've gamed. We were short at all these highs. We were long at nearly all those lows and bullish. Again, that was stating full-on hard long bullish. Apple, Amazon, this is my 2 top picks with an overweighting on the FANGs at the January 1st, right in the beginning of the year, coming out of the gates. Same thing here. Same thing. I can't remember on COVID lows where we exactly reversed. That was an event-based thing, more so than the charts. Same thing on Q418. I know that. Short the highs, covering the lows there. And so this is swing trading. We'll try to get this next one down. It's a pretty big down. But I'm going to show you how and why fundamentally, for those of you that are just saying you're crazy. There's no way in God's green earth that the Nasdaq is going to drop in over half, 50%. When everybody, the vast majority of analysts out there are calling for gains into and through on beyond 2026. All right, let's look at a few things, and these are the big. Look, I could sit here for hours and go over all the different indicators and all this, but we're gonna mesh or marry together technical analysis, which is charting, with fundamental analysis. Although this is a chart, so hence technical analysis, it's really a fundamental factor that will support, that I believe supports the case for such a drop. Now, I wish I could control and make this a log scale chart. I can't. This is a linear index. If you notice from the left to right, here's the S&P 500 scaling. These are equal, so that's linear. Each one is an equal move. And this is the margin, FINRA margin debt. This used to be known as NYSE margin debt, and it's now FINRA margin debt. Same thing. It's how much margin is out there. Your broker, you open a brokerage account, you open a margin account, your broker will give you enough rope to hang yourself. You put in 100,000, you want to buy, juice it up and buy 400,000 in Nvidia, go ahead. Bitcoin, go ahead. That's leverage. And so you borrow that margin, they charge you a small rate of interest on it. And again, this would show so much better if I could control this and put it into log scale. I'll show you why. So this is the blue, the red line is the S&P 500. And see, this doesn't look like much. And of course, it's also the S&P 500, not the Nasdaq 100. The Nasdaq was the primary driver of the dot-com bubble. For those of you familiar, there's 2000. March of 2000, the dot-com bubble popped. It was nearly an 80% drop. Let me repeat that. The Nasdaq crashed 80%. If you had $1 million, you looked, you blinked, and a year or so later, you were down to 200,000. You lost almost all your money. Big drop. S&P wasn't as much because it wasn't the crux. The crux of the dot-com bubble was Nasdaq listed stocks. Tech stocks, dot-com stocks tend to be more in the Nasdaq. Plus, the S&P is more diversified with your steady Eddie blue chip, dividend-paying stocks and utilities and defensive issues like healthcare and all that. So either way, vicious bear market. Even in the S&P, it was a notable bear market, and the drop caused a recession because the drop in wealth effect. But you can see there was a surge there. I think you can see it here. I have to put that arrow tool on again. It makes that pop-up box stop. There was the surge that you had at the top, then the bubble pop. The next real bear market came in, technically peaked in October of 2007. And so what happens in a regular bull market? This is where the bear market ended right here. Here's the inflection point. Bull market began. And what happens as a bull market matures and you get those latter stages, you get people, whether they're new to investing, a lot of them are, older school ones, and they look and they say, why, my Nvidia keeps going up and I'm making so much money. Why don't I borrow on margin and magnify my gains? And you get a lot of speculative players coming in the market, buying things like crypto, all these other red flags in the market. And crypto's peaked, by the way. I'll get to that in another video, but I've covered that many times. But there's that parabolic little spike, or it's indicative of the volume surge on a buying climax, if you will, and which typically marks a top. And then again, this non-log scaling understates. That was about a 57% drop in both the S&P 500 and the Nasdaq 100. So let me repeat, that's the stock market getting cut more than in half. Your 401k, all that stuff. And again, it doesn't look like a lot here because it's non-log scaling, but it is. So as time goes on, you can see we get these surges. This is where we had COVID. The Fed flooded the system with liquidity, brought rates down to near zero. So we had that strong ramp up with excessive liquidity, including free capital. That's where you can borrow on margin for next to nothing. You can get a home equity loan next to nothing, mortgage next to nothing. And so it created this asset bubble, and it peaked there. And then that was the last bear market that we had. A pretty nice one. We traded that down with near impunity to the top to the bottom, gained the two little counter trend bounces in there. And then what happened is we've had this other next leg up. Again, this is the S&P. on that top, margin didn't exceed that previous peak. So this is the what appears to be the final blow, that spike. We're at all-time record highs in margin debt. You can see again the charts right there. There, let me move that pop-up box. And so it's really, to me, not a matter of if, but when. Anytime you start going parabolic, and it meshes with this, the surge up. There was the correction that we traded down. Trump liquidation day ended in the April lows for all the reasons we covered. Shorts went long there. And this is the spike up, a near vertical reversal. And a lot of that's been because Trump continues to chicken out. That whole taco trade. Remember, I discussed that before it even was a thing, that Trump would cow down, that the tariffs, and that was the reason for covering in early April, all shorts, that the tariffs were unsustainable. They were ridiculous. 300% tariffs on China. Come on, the two largest superpowers are going to do that. That would be mutual destruction, self-destruction. And so, like I said back then, that the powers that be would have marched Trump into that dark, deep hidden room below the Oval Office, sit him down in front of the Illuminati who have spoken. And they did. They set him straight. He cowed down, and he's continued to cow down. So I think his credibility is near zero now, with the most recent being cowing down on literally cows, beef prices, all that. Consumers were, upset. And so he's just rolled back tariffs on most of the agricultural commodities, everything from beef and, down to spices and everything, just about everything. So that was a fuel for that. And again, fueled, you need to understand the power of margin. Again, if you have $1 to spend and all of a sudden you're allowed to spend $4, your extended credit or whatever, more than that, futures 10 to 1, you're allowed to buy a lot more. That will fuel, and that is the fuel that's given us this spike up. Somebody in the comment section I replied to today said something about the job market continuing to roll over. Yes, we've seen the clear trend if you read the headlines. And what's perplexed me and others, and I underestimated the impact of AI until I told you I read an article about a week or two ago. I wasn't aware it was this big. I've always said, Economics 101, we all know that consumer spending accounts for about 70% of GDP. So the government can spend their ass off, and they cannot offset what the consumer spending does. But what I read recently is AI spending has accounted for, I can't remember the exact statistic, but it was damn near, and might have been a little more than actual consumer spending, contributed to GDP, that is, most recent GDP. Nearly, if not as much or more than consumer spending, which is an amazing, mind-boggling number. And it also explains a lot. And as we know, there's been a handful of stocks that have done most of the uplift in the market. So, guys, my whole point is understand that this, at some point, it can continue for a while. Just look at 1999. Again, this is not the Nasdaq. The Nasdaq looked like this. Went near parabolic, and then it went like that. These kind of trends can continue for a while, but that's what we're looking at, the charts. And we have sell signals now. So I'm going to treat as I did the previous top. Every top has a potential to be, every top on the 60-minute chart, even that little 15-minute chart, only if and when it coincides with sell signals on the more important daily and weekly chart, which they have, has the potential to be the peak. And then when you have such a surge up like that, like the Nasdaq did back in 2099 into early March of 2000, the analogy that somebody said was, Randy, it's like a roller coaster. You hear it, starting to wobble when it gets up to the top. You get on a roller coaster and it takes you up the track, the chains, and it's creaking, clickety clack, and then you level out and it gives you a second to look down, and then boom, the big drop off. Well, no. To me, my analogy was, if you guys have ever been to Universal Islands of Adventure in Orlando. One of the first roller coasters, when you walk in there on the left, is the Hulk. And so the first time, the Incredible Hulk. first time I went on that roller coaster, my kids were young. I wasn't even watching it really. I was walking up trying to convince them because they were scared. Come on, guys, it'll be fun. It'll be safe. And so I get on the thing with my kids, two boys, and this thing. You load up here, and then you see the lift, and you're expecting, or at least I was. There's a tunnel there, and then it goes like that. Well, what it does, it shoots up. I mean, like multi G. It's scared the hell out of me because I didn't see it. I didn't watch how this thing started out from the ground, and so when they shot up, it surprises you if you don't know it's coming, and it's fun. And then immediately, so once they shoot you up, spring loaded or whatever the hell they do, then the ride, it turns, and of course you're at the peak then, and the bottom comes. So there's none of that wobbling or anything like that. This is kind of what I think this top will most likely look like from a bigger picture when it comes. And again, if NVIDIA is a catalyst, which I think has a good a chance as anything to be, great. And if it's not, 3-6 months from now, I'll be looking for the next catalyst. I can just tell you, without waffling or anything, this is unsustainable, and this is just very typical of a major top. And guys, understand the power, and this is what again I'm trying to explain how this drop for a 50% or more drop in the S&P can come about. This goes the other way. Once a credit or margin bubble bursts, the same crap, think Bitcoin, think of NVIDIA. NVIDIA right now isn't crap, far from it, but it's in a circle jerk of money being spent from Meta, Amazon, Alphabet, Microsoft, goes into NVIDIA, who turns around and makes deals with OpenAI, who turns around and makes deals with AMD, and that's that circle jerk. It's being well documented, and it's going that way right now. And the second, for whatever reason, that it starts to reverse, and it will, maybe it's that the big tech companies, the Alphabets of the world, realize they're not seeing the return on investment that they thought they would, or something else. Maybe it's just the market collapses on its own weight. Maybe it's something NVIDIA says. Maybe it's something somebody else says. And then things start to go the other way. And that same exact vicious cycle reverses. And that will be it. And then what happens is this credit bubble unwinds. And so you have, and you're always going to have permabulls. You're going to have perma-bears on the market, permabulls. You're going to have gold bugs that think gold's always going to go up, no matter how lousy the trend is. And so you're going to have those people that believe in NVIDIA and will, have iron fists. They want to hold NVIDIA for the next 10 years, right? Come rain or shine, hell or high water, they're going to hold it. That's their plan, right? But what happens in the real world when a margin bubble collapses, you may love your NVIDIA, but guess what? When it drops 20 and then 30, 40%, you get a thing called a margin call from your broker. And when I started in the business, I'm going to date myself, it was T plus 7. I came in right around the time that they switched to T plus 5. I was in the mid 90s, meaning you do a trade, you had 7 days and then 5 days and then 3 days, and they keep changing to the settlement period when the money had to be in. So, if I had a client at Merrill Lynch when I started out that had a margin call, I can give them a call. Hey, Bob, I need you to get a margin call here. You got to send in 5,000 into your account, whatever, to meet the margin call. Just put a check in the mail if you can the next few days. I just have to have that in a week or so. That's the old school stuff. But in this day and age of electronic trading, the market has a big down day, NVIDIA, whatever it is and the same folks, I can promise you, to a large extent, not completely, but to a large extent, the folks that are loading up on margin, it's in a bull market, have the high flyers at the top. And back then it was pets.com and anywho.com, all these other .coms. Here it's NVIDIA, Bitcoin, and even lately, like I said, gold and silver, I believe, have joined that crowd. I'll get into gold and silver in the next video when I update trade ideas. You can say what you want about that. But gold bugs will cite, oh yeah, gold is a flight to safety. It's an inflation hedge, all these other things. I've traded in charted gold back longer than I've been alive. And it's on and off. There are times where Gold does very well in an inflationary environment. Think of the 70s, mid 70s. And there are other times where it's actually doing the opposite, whether we have inflation or deflation. I've seen markets where gold is, instead of becoming a flight to safety bid, it was dropping right in lockstep with stocks. So gold kind of does its own thing when it wants to. Same exact thing with Bitcoin. The whole Bitcoin bug theory was, it's an alternative to the rigged system, the financial assets, and they can devalue the dollar. And as you guys know, or you should know if you look at the charts, it's been highlighted here. There are times where it's in lockstep with the market. It's a risk on asset. When the market goes up, it goes up, but it goes up more. And there have been times where it's doing the opposite thing. In fact, lately is a good example. Bitcoin has long since peaked. And the stock market only recently peaked. So that's also on and off. All right. So just understand, understand that those are the main things that folks are buying on margin. And then when it goes the other way, selling begets more selling, because that person that loaded their account with NVIDIA and planned to, hold it for the next 10 years, come hell or high water, they don't have a choice anymore. They don't get a phone call from their broker like I used to have to do. They get a little pop-up on their phone or the computer, because everything's electronic now, shorter settlement days. And a lot of brokers, you have literally to the end of the day. You get a margin call, and that's it. And you have till 4 p.m. to decide what to sell, or they're going to do it for you. And then that selling begets more selling, because everything's going down. So margin selling is exactly just that. A forced margin call causes those people to sell, which selling begets more selling, because the next support levels are broken, and then the next stops are hit, and the next guy or gal gets a margin call, and it goes down. And so we'll see. We're not there yet, guys. I'm just trying to keep this chart. Watch it. You can a lot of sources will give you this. It's free information online. Just Google FINRA margin debt chart. And the other ones are credit spreads are finally starting to perk up. This is from the Federal Reserve Bank of St. Louis, which was known as FRED, their website. And you can see these are credit spreads. After COVID, the government came in with excessive measures, free money for everybody, flooded the system. So we had, unusual low levels. And this has been talked about by both myself and others, including Jamie Dimon for a while, that's saying credit spreads are mispriced. I believe grossly mispriced. And the market has held up just very, very surprisingly well. Again, it's that AI bubble that's yerking it. Remember, the markets and the economy are not one and the same. In fact, they can be very far from it right now. We know that the job market continues to show clear deterioration, but yet the stock market is not too far off, even after last week's correction highs. Because again, the stock market, the indexes, at least the stock market most people are talking about, are either the Dow or in most cases the S&P 500 and the Nasdaq 100, which is reflective of the overweighting from all those AI stocks, NVIDIA, Apple, Amazon, Microsoft. Just the top 5 or handful of stocks make up almost all the returns. And so, but credit spreads until recently have been, moving lower and at relatively low levels. Just from a shorter term, I just stepped down to a 1 year holding, 1 year view. And you can see here, we peaked or troughed there, made about an equal, maybe a slightly higher low there. And so far we now have a slightly higher high. So in other words, it's the early makings of an uptrend. It could be a blip, but this was a downtrend, falling credit spreads, which helped fuel the advance in equities since the liquidation day when Trump cowed down. And if this continues to rise, which I suspect it will, and it can take off fast, that's when you should see junk bonds and everything do really cruddy. And junk bonds are will price in when they start to fall, increased default risk. This one here, I'm just showing you things that the whole point of this, at least this early part of the video, talking about the long-term targets and all that, are to show you just if for those of you that just can't get your head around how can that possibly drop? How can we drop 50%? Especially when everyone's saying that the economy's in solid footing, AI bubbles, the AI story is very much intact and a lot of room to grow. This is the Shiller P ratio. Widely considered the best metric for valuation in the market, also known as a cap adjusted P ratio. And you can see here, this back here, this spike, that is 1929, the crash of 29. That's when the banks failed, started the Great Recession. Very, very, crucial time in the stock market. We had the same thing, a runaway, crazy valuations at that time, unforeseen levels. And then that led to a crash, which again triggered the Great Recession, crash of the stock market. In the early late 60s, early 70s, we peaked again, hit a very high level, and we had, as you know, if you study history, one of the worst and prolonged bear markets back from really the late 60s to the mid 70s. Then there's the dot-com bubble, and again, this one blew away previous valuations, and that was because it was different. The bubble was a little different. The AI, I fully acknowledge it's AI bubble. These companies have real earnings. And back then in the dot-com era, most of those companies didn't have any earnings. A lot of them didn't even have a sound business model or any management with a proven track record. So you did get valuations very wonky. And again, it was more confined to the Nasdaq 100 or the Nasdaq Composite. This time around, it is different because you have much higher weighting of these AI stocks that are the bubble in the S&P 500, and I just want to point that out. But there's where the Shiller P ratio is. Nosebleed levels right there, almost to where we were in the dot-com bubble and way above where we were. The last real bear market we had was it peaked in 2007, October 07. Financial crisis came, 55% drop in the equity markets. So at best, and again, if you go through a lot of analysts, economists, when you see such high valuations in the market, it's indicating, and again, everyone has different numbers, but the numbers I'm seeing, at best case, you're looking at flat to possibly negative or barely positive returns over the next 10 years. That's what it's telling us here. So basically, the risk-reward profile right now for a long-term investor is as bad as it's been since the dot-com bubble back then. That means, and it took the Nasdaq here. I'll show it to you. Let's go back. We'll do QQQ here. Here's QQQ. Let me turn off that comparison right there. Who are we looking at? The S&P 500. Okay, so there was QQQ, which again, QQQ is the Nasdaq 100. That's the creme de la creme of the Nasdaq, and that still fell 84%, right? And it took, so you know, if you were the poor guy or gal that bought in at the high right there, chasing a lot like NVIDIA now, and the AI bubble, it took, let me just measure it here. Let me grab right above that candle, just move over to this point. It took about 16, 17 years before you broke above that level right here. About 17 years. So almost 2 decades to get back to where you were if you bought into that bubble. And again, after an 84% drop, which this is how they usually come. They go up like this. That's almost a near, like a kind of a V-ish top. And let me just change my tool here. Let's go to the arrow. Let's change the color. There we go. And you can see we fell just as fast and hard as we did coming on the way up right there, right? This is a more orderly bull market, but we still had a 55% drop. And so this is that kind of that surge, if you will, that I compared to that roller coaster. Again, if you guys have ridden the Incredible Hulk there in Orlando, then you know that's that initial surge up, and it can come hard and fast, and probably will, based on everything that I just showed you fundamentally, the extreme valuations, and really the margin debt from the unwind when it goes the other way. Right now, it's still going one way, and that is fueling liquidity. And in addition to whatever the Fed is doing right now, they're resumed. When the shutdown ended, they started to resume operations. There'll be liquidity injections into the market, but this is unsustainable. When this goes the other way, there's going to be a powerful undoing. Okay. All right. So I've given you the updated longer term. I give you targets on the daily and the weekly chart for those who are interested in QQQ. I'm not going to give upside targets if you're bullish, because we're at, when you're near all-time highs, there are no price targets. You can kind of guess. There are things like Fibonacci projections and other things you can do. But like I said, it's at a point where if I have to sit and as long as the technical postures and these extreme valuations, which I don't see any way out of it, remain this high, I'll just keep looking for each of these little 60-minute chart breakdowns and sell signals, especially when we have sell signals on the daily and weekly charts like we do now. I'll be treating that, as I have for the last year, as the potential to be the top. All right. And so you will continue to get, and I'll do another video today, a lot of trade ideas, a lot of longs out there, both individual stocks, commodities, and other things like that. So I'll continue to kind of both spread my bets personally, but then also to share ideas with you. As I told you, I'm not as keen right now in taking longs as I was for the last few months, based on the sell signals we have on the equity markets, and we'll see what NVIDIA does. But this is Bitcoin. This is the actual BTC crypto, Bitcoin crypto. Right there's your uptrend line, and there's the breakdown. I've highlighted this. Crypto has long since peaked right here. Well, recently. The big bearish rising wedge, that was a divergent high, just like that divergent high, which ended with a divergent low. So we're on a sell signal there. IBIT, and this is where this very much plays into my my thought process and my thinking too, is that crypto is just going to be go down in history as the kind of the signature for this bear market, the bubble, if you will, the speculative bubble. AI is more of a look. The AI thing was real. The earnings were real so far. The advances and everything. Again, a lot of companies are still grossly underwater for those that invest. The biggest beneficiary has been NVIDIA, because again, they're making the chips. When it goes the other way, you'll see that stock will collapse and crater, and it'll keep doing it long beyond where anyone thinks it's going to stop. And again, I've made this from a fundamental perspective. I guarantee you, countries like, not limited to, but especially China, are out there, and God knows they're resourceful as hell. They're not going to sit there and play second fiddle, and just, okay, we can't buy the latest chips anymore from the U.S. They're going to come out and they're going to, start making chips that are going to meet or exceed NVIDIA. And then once that happens, they're just done. You're not going to keep, reign supreme title with these chips. Not to mention the shelf life on those chips are just limited. So it's not like, when they built out back in the dot-com bubble, a lot of the hype and the money and the stocks that were going parabolic, where they were laying fiber optic cables. Remember the global crossings of the world, WorldCom. And but that infrastructure was laid. It took a while to pay up, but it was still in the ground, and they're still being used today. And so the money that was plowed into those technologies, ultimately we're able to and continue to be able to be capitalized on. But a NVIDIA chip, in 5 years from now, these Blackwell chips will be like, the chips of whatever was big 5-10 years ago with Intel that aren't even in, like a Pentium 1. They're going to be worthless. So those, that's the problem with, chips. It's not, you're not going to be using the same chips 5-7 years from now. So, but yet they're putting massive amounts into them. But here's the one I want to talk about. So this is, again, there's already been a massive amount of wealth destroyed. So you're going to see when that FINRA margin debt bubble that I showed you collapses and starts to go the other way, and then selling begets more selling, That's going to put stocks down. The wealth effect, the collapse on the wealth effect is going to be incredible because we know that it's only been the high-end consumer, those that have stocks, have a lot of money in stocks and houses. They're going to start buckling, tighten the buckles. But that's going to go down, and there's been massive amounts of money put into Bitcoin, both the crypto, and think about the amount of crypto derivatives. Those are going to be your crypto ETFs. There's two types of crypto ETFs. The spot ones like this that all came out that were approved here in early 2024. And then the previous ones like GBTC that track the futures. And then you have the futures themselves. BRR is a symbol for your Bitcoin futures. And so that market trades infinitely more. So by legitimizing this bubble and then rolling out these ETFs and the futures contracts that came before them, all that money, remember, NVIDIA, I don't think, at least not in the foreseeable future, is going to go away. I might call for a 70% drop in NVIDIA, which I do, but I don't think they're going to close the doors and go bankrupt and go poof. They'll continue to hopefully evolve, make chips. They won't be, the profit margins won't be anything like they are now. They'll be facing a lot more competition in the future. But remember, Bitcoin's a big fat nothing. Like Charlie Munger said, it's the currency of drug smugglers and traffickers, sex traffickers, and the likes. And at the end of the day, there's no earnings. There's no real value. And so as this continues to explode and collapse, it's just it's going to wipe out a lot of found money, if you will. Again, one share of NVIDIA is a claim on future earnings. That's what equity markets are. That's what the stock market is. When you invest in a company, if you buy Microsoft today or Apple, you don't just own their intangible rights, the property right. You have the claim on all future earnings. They have physical properties, real estate, tons of patents. So there's a lot of tangible and intangible value there. With crypto, there's nothing. It's a big fat nothing. And now they've leveraged up and put derivatives, ETFs, futures on something that has no value, no earnings. And so that plays into it all as well there. I've given you, we're coming up on targets. I've given you, most recently, I gave you not just Bitcoin as a break of that 61.55 level. We're at my 53.18 target now. But the proxies too. MicroStrategy, that was a short here. That was back on, I shared that one with NQ, Dollar General, NQ. Remember, before this recent trade on the 60-minute chart NQ, we had one here. I give you two sold targets, T1 and T2. We hit T2. That was the final target. And then we went up, made a marginal new high. Here, that's right here. Nope, right here. That was it, right here. So that was that sell signal. Boom, boom. First targets hit, went up, made a new high. Now we had this trade, 1, 2, 3, 4, 5, 6 targets. T6 will most likely be hit after NVIDIA reports. And then, again, as I just showed you in the video, I'm turning my focus to longer term charts. So that was then, boom, boom, exactly where we went. Final target hit, went up, new high, new trade. MicroStrategy. Obviously, my arrows show which way I think it's going. I said whether it's bullish, because I know a lot on the site were. You could buy pullbacks to the trend line. However, those bearish can wait for a solid break below. And I gave you can see here, targets at, this was first, you can see I didn't even have an arrow break because that's mild resistance, I'm sorry. 280, then 234, 02, 178. And then the next target there. So I just wanted to update this. We're coming up on T2. There's that 234.02 target we already hit. I already updated you on that. Coming up on T2. And then by the time we get here, so right now, since the breakdown, which was a break of the wedge, this one's already good for about a 36% profit. When we get down here, MicroStrategy, which is one of the king of the what I call the Bitcoin proxies, that's going to be a 66% drop. It's going to, these are where a lot of this is right now. This is in, I know from doing this a long time, being a former stockbroker, financial advisor, The folks that are leveraging up right now are the ones in these type of stocks, right? The Bitcoins of the world, the micro strategies, the Nvidia. It's all part of the bubble. It's almost a it's pretty much a near certainty, and so that's the unwind. And so what's going to happen? The further this drops, the more and more forced margin call selling is going to happen. All right, so that's enough. Let me see if there's anything else I want to cover. So you got the long-term stuff. I covered the Shiller P ratio. I covered the uptick in credit spreads recently. Again, something to monitor. Oh, on that, look at the bonds themselves. So BIZD, I've already covered this ad nauseum. Started harping on it here long before it was in the headlines. And I kept telling you, when we get down here somewhere, you're going to start seeing it in the headlines. BIZD and the BDCs, of business private credit. And sure enough, you did. When we hit that fourth and final target, recovered, went long, gave you 3 targets, 1, 2, 3. Once we hit T2, I changed my mind, said we're going to cancel that one. And so you can see this was a perfect exit, perfect entry. And more so what's going on in the credit markets. That's why I'm highlighting this one. But there's other things out there too. The junk bond market, which business private credit was the first to crack, in my opinion. What will follow are these junk bonds that are not being priced in. The credit spreads are too low. This has fallen, FALN. This one's already broken down, back test and moving lower. SJB is a ETF for short high yield. Let me just look at the actual high yield for you. SPHY, Spider's Portfolio High Yield Bond ETF. So my high yield bonds have broken down, back tested, and most of them right now are testing key support with a breakdown. This is where credit spreads really start to, remember, they've already started. I showed you earlier in the video right here that they've been ticking up recently. And that's also indicative. I told you, if you don't want to follow, it's easy to do because this is free information. You can Google the credit spread charts or go to Fred or any of those sites that publish them. But you can also just watch junk bonds. You want to watch them relative to treasuries. JNK is a junk bond ETF, one of three that I track. And that you can see there's your uptrend line, breakdown, back test, testing the 200s and price support. HYG is another big junk bond ETF. Same thing. They're all testing support right now. So when these break down, that will most likely be coinciding with the drop in the equity markets. Junk bonds, of all the type of bonds out there, only these trade much more and almost exactly like the stocks. They're going to trade like the stock market. All other bonds, particularly treasuries and investment grade corporates, they go up and down depending on where interest rates go. They're rate sensitive, and it's an immutable correlation on treasuries. Rates go up, treasuries go down, and but these guys, you can see interest rates moving down, but if their prices don't go up, that's because there's worries about the credit, so they're being sold, and the credit's being downgraded, the ratings on a lot of these bonds, or you're seeing actual bankruptcies. And again, you can see actual or the worries about increasing defaults. And that's where, and it always happens, every bear market, you can go back in history and see the junk bonds. And again, you can overlay, don't take my word for it, just pull up HYG or JNK and overlay a long-term chart, go back as many years as you can to these guys came out, overlay it to the stock market, and you'll see the very strong correlation there. So they trade more like stocks. SHY, short-term bonds. Let's talk TLT and then we'll wrap this up. TLT, treasuries. Remember, TYX is the yield of the 30-year bond. And this is what's going on in the economy. Fed started cutting rates here. That was the 3 back-to-back rate cuts, starting with the big 50 basis point. Fed realized they lost control because instead of long-term rates falling as they wanted to see, long-term rates went up. I talked about it this time, same thing. They started cutting right here at the arrow, this line I have. And rates have, they went up right away, briefly went a bit lower, and they're back above where the Fed started this last rate cutting cycle. So the Fed has lost control of the yield curve. They lost control back then. And so if this continues to go like this, that will be the fundamental catalyst that will be the knife through the heart of this bull market. Rates, I'm surprised. I'm honest to God surprised that when we look at the yield, this is the yield on the 30-year. We go back weekly right here. Turn off all the lines. I'm surprised that the market has been able to hold up as well as it has with this backup in yields. Again, interest rates going back to where they were. This is the financial crisis right here, the peak right before the financial crisis started. That's 2008 when everything melted down. Yields go down during that period. Bonds went up, especially treasuries, a flight to safety. And but we're back to that interest rate environment. This was all the years and years of excessively low, artificially low interest rates. And this will matter. Again, this is, textbooks, fundamental analysis, economics 101. These higher yields will eventually translate into lower returns on the stock market. Okay, guys. All right. So this one, again, was more, as much of anything. I covered a lot of technicals. I gave you levels. I even started out with short-term stuff if you're interested in trying to thread the needle. But remember, it gets a little more difficult with NVIDIA reporting on Wednesday. So, again, if you don't know what to do, best thing to do is nothing. Keep it light. Have a trading plan. If you are short, if you've taken any of the recent sell signals, you know where your stop should be. Depends where your targets are. If you traded off this 15-minute chart and you took this first short entry here, I give you a total of 5 targets. The fourth was just hit on Friday. You sit tight. At this point, there is absolutely no reason to let a nice winning trade turn into a loser. So at minimum, I think your stop should be raised down to entry, if not lower. We've been zigzagging lower. This is a textbook, it's a volatility's up, so the moves are pretty high, but this is a downtrend, lower highs and lower lows. And so if we go down to T6, like I said, there's just so much hot air that if NVIDIA shits the bed, we'll probably blast on through T6. And that's why I told you I'm going to focus on and gave you these additional targets for both typical swing and trend traders in the weekly chart right there. T1, T2, T3, still T3 that was hit here before, 4, 5, 6, 7, or you go down to the daily chart. There's your targets on the daily, T1, T2, we'll just leave it there for now. And, again, your stop, I can't give you a suggested stop because I don't know if you took a full short there on the back test, partial, in, out. Been doing what I do in gaming, on the active trading account, in, out, long, short a dozen times last week. Second breakdown there, second back test there. The 50-day, once that gets taken out, again, so far they've successfully defended it on every test. This was an intraday pop. The 50 is a yellow line. Intraday pop, test, intraday, that was an intraday drop followed by a close back above. Intraday drop followed by a close back above. Today we tested the 50 again and closed back above it. So you can't get too bearish until the 50 goes. And again, NVIDIA coming up in a couple days, keep it light. I think it's the RR warrants, taking a short position into that, on the equity markets. I wouldn't, you gamble NVIDIA if you want, but that's going to be, you're either going to be very happy or very sad if you have only a NVIDIA short. So when you go with NQ, you've got a lot of exposure to NVIDIA, but you've also got some other things in there to smooth it out. All right, let me wrap it up here, and then I'll start stitching together a video of everything else, the grains and other agricultural commodities, precious metals, natural gas, and then of course there's a ton of individual stocks thrown out there in sectors, so we'll get to those later. Financials, by the way, I've noted are down today, which is what I've been waiting for and expecting, and that's the final shoe to drop really for the S&P once XLF takes this level out. That'll be lights out, and the VIX should be rocking and rolling. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.